Hello my fellow investors and welcome back to another stock analysis video as well as earnings report. And today guys, we're going to take a look at the company Best Buy. They just had their Q3 fiscal year 2023 earnings report and well, a lot of stuff happened with this company today. Oh dear Lord, wait until you guys see that graph. It is just absolutely insane. So let's take a look at their earnings, take a look at their fundamentals and make some assumptions and see if maybe we would like to buy this company at the current moment. So with that said, let's get started with this analysis. Okay guys, we're going to jump right into Seeking Alpha to see the overview of their earnings. We got EPS normalized actual $1.38. This was a beat by 36 cents. EPS GAAP actual $1.22, a beat by 19 cents. Revenue actual $10.59 billion, which is a beat by $285.09 million. So everything here guys was a beat overall. Sounds really good, right? Except that when it comes to analyst expectations, sure, they beat everything, but remember, we can't just take a look at analyst expectations. We need to take a look at the company year over year when it comes to their earnings, because sure, they may have beaten on analyst expectations, but at the end of the day, if you see that the company year over year has been decreasing when it comes to their revenue, when it comes to their income, beating analyst expectation doesn't necessarily mean anything. So let's actually now come into the earnings report, and this is very interesting. Now remember, when we analyze a retail store guys, we have to take a look at something called comparable store sales. This is very important. Essentially, this is the sales per store that they have. Basically, you want a company to be increasing their comparable store sales in total because open up more and more stores, right? And their revenue actually go down overall, but it may look like it's increasing because they're opening up more stores, right? Comparable store sales is essentially the revenue per store that they have open. And as you guys can see right here, Best Buy actually puts it out for us right there, smack in the middle. The first thing we see, comparable store sales declined by 10.4%. which is very bad, guys. Very bad. GAAP diluted EPS $1.22. We saw this. Non-GAAP diluted $1.38. Raises full year guidance and resumes share repurchases. Okay, so we got here a couple of bad things, but a couple of good things too. So let's actually come down here to guys, the highlights when it comes to this revenue. So we got the enterprise, and I believe that this is the overall revenue when it comes to comparable store sales. So we got here Q3 2022, $11.9 billion, and in Q3 fiscal year 2023 guys, we got $10.6 billion. So that was a pretty big decrease. Domestic segment went from 11 billion to 9.8 billion. International segment 925 million to 787 million. Okay, enterprise comparable change right here, this is the 10.4, right? Okay, yep, there it is. So that is a very big decrease, guys. When it comes to the domestic comparable sales, that is a decrease of 10.5. So that's even more than that of the enterprise comparable store sales. When it comes to the domestic comparable online sales, that is very important right there, because you would think, okay, well, maybe they're not selling a lot when it comes to physical stores, but maybe people are buying them online. Yeah, that is a decrease of 11.6. And in 2022, guys, it was a decrease of 10.1. So it was even more of a decrease this time around. International comparable sales, it was 9.3 compared to 2022 of 3%. That is just awful overall. When it comes to the operating income, we got GAAP operating income as a percent of revenue 3.4 as opposed to in 2022, which was 5.6. Non-GAAP operating income as a percentage of revenue 3.9 as opposed to 5.8. Guys, that's very bad, like really bad. GAAP diluted EPS went from $2 to now $1.22, and non-GAAP diluted EPS $2.08 to $1.38. Wow, guys, that is very bad. Very bad overall. Now let's actually read a couple of the statements from the CEO. So we got here, I am proud of our team's execution and their relentless focus on providing amazing service to our customers during what is clearly a challenging environment for our industry. Boy, is it. Throughout the quarter, we were committed to balancing near-term response to current conditions and managing well what it is in our control, while also advancing our strategic initiatives and investing in areas important for our long-term growth. As a result, we delivered Q3 results ahead of our expectations coming into the quarter. interesting. Okay, the holiday shopping season has begun, and now more than ever, our customers are looking to bring joy back into the celebration. Except the thing is that, well, Best Buy mainly has discretionary stuff. People are mainly starting to buy, staple stuff, so food. I don't know how well this is going to turn out. But anyways, he continues to say, quote, "We have strategically and effectively managed our inventory flow based on shopping patterns that we believe looks more similar to historical holiday periods, with customer shopping activity concentrated on Black Friday week and Cyber Monday and 2 weeks leading up to December 25th. We're excited about the promotions and values we have planned, including special offers available to Total Tech and My Best Buy members. We have tailored our offerings to delight our customers, whatever their budget." This is very, very interesting. This was honestly just a whole lot of nothing. Like, I just gotta say it outright, guys. This just seemed like a bunch of word salad in my personal opinion. I don't know what else to say about this. But he does mention something about fiscal year guidance, guys. This is very, very important because this is what's going to tell us essentially what they're planning, or at least what their vision is. So we got here. He continues to say, "We're updating our fiscal year 2022 outlook to flow through our better than expected Q3 results while keeping our Q4 expectations unchanged." Okay, so apparently, guys, they are considered this Q3 results actually not too bad. So they were actually expecting even worse, apparently. And by the looks of it, they are keeping Q4 the exact same way. So that's very, very interesting. And this was brought up by Matt Belunes, which is the CFO of Best Buy. "We now expect comparable sales to decline approximately 10% and our non-GAAP operating income rate to be slightly higher than 4%. He added, "From a capital allocation perspective, we resumed our share repurchase in November after pausing during Q2 and now expect to spend approximately $1 billion in share repurchase this year." Okay, so not too bad. They're continuing their share buyback, which is very, very good. So now, guys, that was essentially the earnings report. I will leave the link to this page in the description below if you guys would like to read it more. It is very, very lengthy. Again, I'm not going to go through it all, but if you guys want to, the link will be in the description below. So with all of that said, how did this come across through the share price? Well, you're probably thinking everything was in the negatives, right? They did worse, but then they beat analyst estimates. What in the world happened here? Like, I really am curious. Well, guys, Best Buy gained today, as if I'm recording this, it is 10 p.m. on November 22nd, guys. Take a look at this. On the intraday trading day, 12.78%. 12.78%. Dear Lord, current share price of $79.88. Post market, it did go down by around a little bit more than 0.5% to now a share price of $79.49. All this occurred because they beat analyst estimates. That's literally it. And of course, forward guidance, because apparently they're still expecting a pretty good forward guidance, or at least the same forward guidance for Q4. But this mainly happened because of analyst estimates. They beat analyst estimates, even though we just saw that year over year, 2022 to 2023, they've been going down in pretty much everything. And they're even expecting a decline in comparable sales for Q4 as well, by around 10% or so. Now, that's very surprising because the fact that this still went up after all of that says a lot that when it comes to analyst estimates, it's very, very good for the short term, not necessarily good for the long term. In fact, take a look at this. On the 1 year chart, guys, this company is down 42.12%. On the year to date, they're down 21.78%. 52-week ranges, guys, is $60.79 to $121.87. So very, very interesting. This whole entire thing, it is just absolutely crazy. So now let's come over here, guys, into the calculator and take a look at the fundamentals as well. We got the ticker symbol for BBY, market cap of almost $18 billion, a PE of 10.69. So with a current share price of $79.88, again, based off the PE, this is looking fairly decent. They do pay out a dividend of $3.52, which is a yield of almost 5%. That is insane too, guys. Payout ratio of 42.17%. A 5-year CAGR, 20.77%. 11 consecutive years of dividend growth. Ex-dividend date passed as of September 19th. Payout date was October 11th, and they pay their dividends quarterly. Based on the current shares outstanding, with this dividend, they pay out $793.76 million. And after this is paid out, they're still left with $1.5 billion in their 5-year average free cash flow. And as of their last year's free cash flow, they're still left with $1.7 billion. These payout ratios are very, very tiny at 31.56% for the last year's free cash flow and 34.23% for their 5-year average. So not only can they afford to pay this $3.52 dividend, i.e. a 5% yield, but they can also increase it if they wish to do so in the future. Coming now into the fundamentals, we got the net income of $1 billion to $2.4 billion, increase of 145%. Free cash flow, we got $1.45 billion to $2.51 billion, increase of 73% with an average of $2.32 billion. Looking now into the revenue, we got 5 years ago $42.15 billion to $51.76 billion, increase of 22.8%. Total assets minus total liabilities, they're currently at almost $3 billion, so pretty much in line with what they have been doing on average, except for 2 years ago where they just skyrocketed. Average total assets is around 16.4 billion. Average liabilities is almost 13 billion. Doing this difference, we get around $3.47 billion. Looking now into the cash flow minus liabilities, as of 1 year ago, they're at negative $11.5 billion, and they had some instances where they have brought this closer down to zero. Average cash flow minus the average liabilities, we get negative $10.6 billion. Shares outstanding, guys, this is where they shine, and by the looks of it, they will continue to be buying back shares at a pretty good rate. So looking at this, 5 years ago, it was 283 million shares to today, guys, of 225.5 million shares. That is a massive decrease on the 5-year of 20.32%. And from the previous year to the current year, that is another decrease of 0.84%. And when it comes to the cash and equivalents, they currently hold $932 million with an average of $2.44 billion. Alright guys, now let's come over here and make some assumptions, low, medium, high, using of course revenue growth, projected share buyback, and the required rate of return. I'm going to put the revenue growth, guys, of -4, -3, and -2. Projected share buyback of 5, 6, and 7%. With a required rate of return of 10%, this puts me between the buy ranges of $131.34 to $144.27. Now adjusting for debt, this comes down to $121.32 to $134.05, putting a margin of safety of 5, 10, 15%. This is now between $103.13 to $127.35. So I actually would like to do something else. Now let's actually say that they do the worst, guys. Let's say that they do the negative 10% when it comes to their revenue year over year. So not just this year alone. No. We're going to do essentially the whole entire 3 years to come. They're going to actually lose 10%. Again, I don't think that that will happen, but let's entertain this fact. So let's come over here, guys, and put -10. And essentially a $1 billion share repurchase at the current share price of around $80 is actually a projected share buyback of like 6%. So doing this, we get the target share prices, guys, for $105.68, not adjusting for debt. Adjusting for debt, $95.56, and with the highest margin of safety of 15%, this is $81.23. So even assuming this worst case scenario, and by the way, this worst case scenario is spread out in the next 3 years. So essentially divide this and this by 3, and that's how you essentially get these values. So that's not just this year, it's actually even smaller than that. I'm assuming the worst case scenario that they'll lose 10% in the next 3 years. So spread out in the next 3 years. We're still at a good buy-in price, guys, $81.23 at the lowest, and the current share price is essentially $80. So as it currently stands, based off of these assumptions, this is still looking like a pretty good price to buy it at. Does this mean that you buy it? Absolutely not. Please do your own due diligence. Read that earnings report if you still like this company. They do have a lot of good things with them, guys. Their fundamentals are fairly decent. However, that comparable store sales going down, that's fairly worrisome. That's a major red flag in my personal opinion. And on top of that, they do have to also fight against companies like Amazon as well. So think about that when you want to buy into a company like this. So please have this calculator, make your own assumptions, read the earnings report. It will be in the link in the description below. Make your own assumptions. This is not financial advice. Every investment is the present value of all future cash flow. That's why I always give these calculators out for free, guys. Make your own assumptions. So please have them. It's in the link in the description below as well. It's called the All Calculators video. In that video, I essentially go through like how to download it, how to set it up, where to find all the numbers, etc. So please have it, make your own assumptions. All I'm asking for in return for this kind of content, guys, and free stuff is just help me grow my channel. Like, subscribe, comment. It really does help. I really do appreciate it. 1,540 subscribers. I cannot believe it, guys. I just cannot believe it. You're all just insane. I just cannot believe it. Yeah, it is what it is, man. Like just yesterday on the 21st, I got my first YouTube paycheck. So that's insane. I never thought I would get paid by YouTube. that is so crazy. It's so insane to me. So again, thank you all so much. That's really all I'm asking for, is just help me grow my channel. Now, I don't really have sponsorships. I don't plan on having sponsorships unless it's like food related. But aside from that, guys, you know, just help me grow my channel. Like, subscribe, comment. It really does help. Now, let's actually take a look at this dividend because, well, guys, this is looking like a very, very good price to buy it at. Again, based off of my assumptions. Putting in $5,725, guys, into this company, this would buy you 71.67 shares. And the current annual dividends per share of $3.52, this nets you an annual dividends of a whopping $252.29, quarterly dividends of $63.07, and a monthly dividend of $21.02. So you're getting a really nice big juicy dividend, guys, at the current share price. All in all, when it comes to Best Buy, I actually considered buying into this company a while back. Then I started to look further into like how many stores they got, comparable store sales, and I'm just like, ooh, this is not looking too good. So I refrained from it. Maybe if you guys see something in it, maybe you would like to buy it. But for me, I'm kind of just staying away from any more kind of retail stores in my personal opinion. So that pretty much does it for this video, everybody. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. Have a great Thanksgiving. I will not be putting out a video on Thanksgiving, guys. Have fun with your family. I will be putting one out again on Friday, but for Thanksgiving, you know, enjoy time with your family. So with that said, peace out, and I will see you all in the next earnings report video.